Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil this morning trading a little bit down on the sort of continuous downward trend now we've seen over a few sessions. Brent at 87.63, sort of getting back to that level that we saw prior to the tragic events unraveling in Palestine over the last 2 weeks or so. And so it sort of begs the question, has the geopolitical premium been squeezed out of this market? Paul Horsnell, head of commodities research at Standard Chartered Bank. Your thoughts of the sort of fundamentals of this market, supply demand versus the geopolitical risk that sort of hovers all the time?
Yeah, it's a difficult market, I think, for traders at the moment, partly because the fundamentals that they're there, but they're not really playing a very large role in terms of price formation. It's very headline driven. It's a complex situation, which markets tend not to be very good at complex situations that unwind over a period of weeks or months, or in some cases years. And so it's very much driven by those short-term headlines without there necessarily being a particularly compelling narrative about anything other than those headlines. I think from the sort of fundamental and, is there a risk premium? Is there a geopolitical premium? I think I'd argue, if anything, that premium is negative at the moment, that if the events of August the 7th hadn't happened, we're probably at a higher price, because what's happened is that fundamentals have been so left on the sidelines, continuing strong draws, the expectation of draws continuing through to the end of the year. Some very strong US weekly data last week, really lost in the noise. And so given that, I suspect we would have been higher. So it's a distraction in a sense of a market that doesn't know how to trade it, but knows it's important, but hasn't yet really come to a view on why it's important. So very, very difficult market for traders. And I think one of your panelists earlier this week made the same point. It's if you try trading this in terms of pure fundamentals, you'll be caught, because that headline risk is moving the market around with greater volatility and in sometimes rather unpredictable directions. So odd answer, maybe a negative geopolitical premium at the moment.
Jamie Ingram, Senior Editor, Middle East Economic Survey. Jamie, we have the Saudi Energy Minister talking yesterday. Whenever, obviously, he talks, we should pay attention, speaking at the annual investment forum in Riyadh. And not only with one interviewer, but two interviewers at the same time. He sort of reiterated the commitment of the Saudi-Russian pact regarding OPEC plus. Anything you heard from his comments that give you some guidance on where things may move into the new year with the unilateral OPEC cuts?
Hi, good morning, Sean. Good to be here again. Yeah, a lot of the comments and a lot of the line of questions that was addressed to him yesterday was kind of looking more at the long-term picture. Obviously, that came out. The talk was on the same day as the IEA released its World Energy Outlook. So the talk was a lot focused towards what's going to happen 2030, 2040, 2050, rather than the immediate picture of the situation now. Clearly he did say on the sidelines that their ironclad commitment to OPEC plus with Russia remains. That was to the surprise of no one, quite frankly. This is an alliance that they are very much committed to. It showcases the fact that both of them are big players on the global supply and demand oil picture of the oil markets. They clearly want to showcase just how much of an impact they have had, getting us through issues such as the fallout from OPEC, way back when the oil minister first came onto the scene in his position, but also more pertinently the COVID pandemic, the fallout from the Russia-Ukraine conflict. These are the big picture issues that they like to point to about how much of a balancing act they are, how positive they are for the global oil markets. So I frankly, when it comes to now, we're looking towards 2024. We're thinking that the 1 million barrels a day voluntary cuts that Saudi Arabia's implemented, these are the big things that everybody's focusing on. We're at the moment, we're at a bit of a cliff edge. They are meant to end at the end of 2023. We doubt that will happen. We expect they will be rolled over to some extent into 2024. The question is, do they bring them all into Q1, or do they start to taper these cuts slightly? That's what we expect, that we'll see a gradual coming off of 250,000 barrels a day here or there.
The question looks, where things go, but I'd like to welcome James McCallum, chairman of Exergy and also a visiting professor at Strathclyde University. James, I've been thinking a lot about what you must be thinking watching the recent acquisitions of ExxonMobil buying up and Chevron buying up the big actors in the shale basin. Exxon paying $60 billion for Pioneer and Chevron $50 billion for Hess. Your thoughts at this time of the cycle, these mergers, these acquisitions? You yourself have participated in being acquired at the top of the market in previous cycles. What do you read into this?
Well, clearly, I think it's part of the bigger picture move of the super majors and the NOCs towards strengthening their position around hydrocarbon production, whether that's in the shale basin or indeed investing in capex generally. And certainly the Saudi minister touched on that as well in his talk, sort of reflecting that he sees oil demand back at around about 103, 104 million barrels of oil a day in around about 6 or 7 months' time. So back to pre-COVID levels and continuing to grow. And the point that Jamie made there, a difference between the IEA and the minister there between when peak oil would occur and indeed, IEA claiming by 2030, and the Saudi minister sort of like saying, if it did happen, it would be at least 2045, at that point. So the super majors investing in traditional hydrocarbon production, and we've seen that move steadily over the course of the last year to 2 years, where those super majors who were not heavily into the energy transition, trading at a premium stock price, the European super majors, Total, BP, Shell, their share prices suppressed because of how vocal they were.
Who are busy buying battery companies and other transition investments, wind farms and so forth.
They are, Sean, but they're also beginning to water down the message of the commitment to the energy transition that they were making 24 months ago. And if you look at the stock price performances of the European super majors over the last year versus the US, they have seen, quite a recovery against the US super majors. And that's coming as they reaffirm their commitment to the oil and gas sector and to the investments that they're likely to make. But I do want to emphasize here, Sean, that whilst there is rhetoric in the markets, there's not any big moves in the market other than acquisition or merger activity. The US rig count, in actual fact, is down 147 rigs from a year ago. Internationally, up a little bit from a year ago, but there's no big moves into adding new well capacity or production capacity yet, but it is coming.
Paul, where are we at in the sort of the other big narrative? Of course, it's been sort of very much influencing all markets over the last year, which is the tightening cycle, the monetary policy tightening cycle of the Fed most pronounced, as well as the European Central Bank and the Bank of England. Where its influence on the market, its relevance. We had Jamie Dimon in Riyadh yesterday, also at the same event as the energy minister of Saudi Arabia. Jamie Dimon saying that further interest rate hikes are irrelevant. Where do we think this cycle is at the moment and its relevance to the market?
Yeah, and I think, remember that period, really through most of the first half of this year, where oil found that narrative a very strong headwind, simply because if there was a bad bit of economic data, the market tended to weaken on the basis that oil demand might be weaker. If there was a strong bit of economic data, the oil market also weakened because it was afraid that it would meant an extension of the hiking cycle and a higher peak. And that sort of vicious circle whereby either good economic news or bad economic news was bad for the oil price. It left us in that sort of treacle we waded through for 4 or 5 months. And that appeared to have gone. But over the past couple of weeks, again, part of the market searching around for a narrative, something to focus on. I have seen over the past week both good news and bad news greeted as negative inside the oil market. So we're not there yet, but there is a concern that maybe we're slipping back into that sort of very macro-driven, but not macro-driven in the normal way. It's an asymmetry. And not there yet, but I think there is some concern that the hiking cycle is now starting to sort of come back to the fore as being perhaps the most convenient, the easiest narrative for traders to latch on to.
Jamie, I was quite intrigued by the article you posted yesterday on LinkedIn and obviously in the MEIS publication, which was highlighting that Kuwait's crude oil exports as a share of its total exports are falling because of their massive increase in refining capacity, with crude oil now below 60% of the total. What are the implications of that, do you think, going forward, not only for Kuwait, but we've got refining capacity in other places, so less crude and more products moving, and does it have bearings for OPEC plus quotas and such things?
Thanks, Sean. Good to see the LinkedIn post get some traction. Thanks for the plug. Yeah, I think this is one of the most interesting dynamics within the Gulf energy sector at the moment. This pivot that we're seeing from Kuwait as it's finally brought online some pretty delayed refinery upgrades and expansions with the Al Zour refinery, which is, well, according to Sheikh Nawaf, the head of KPC, that Al Zour is now running at full capacity. There'll be an announcement confirming this in just the days to come. They're just checking to make sure nothing kind of goes bang in the night before they make that announcement effectively. As you say, yeah, the crude oil exports are now below 60%. That obviously has a big bearing, given that Kuwait also likes to say just how much of a reliable supplier they are. They have their long-term crude agreements in place for 2023. We're going to start seeing them signing agreements for 2024. They don't want to be pulling the plug on any of their loyal buyers. They like to talk about the strong partnership they have, especially as a lot of their clients essentially set their refineries up in the first place to run on a heavy baseload of Kuwaiti crude. So it's interesting that they brought this on at this particular time in the market, because we've seen Saudi Aramco take that stake with Rongsheng in China. So they're starting to sell a lot more crude into some of these Chinese independent buyers, which have traditionally, well, more recently anyway, been buyers of Kuwaiti crude. So for Kuwait, that's quite good. It means they can essentially say to Rongsheng, okay, you're ZPC affiliate, you don't need Kuwaiti crude anymore, you're happy with Aramco. So we'll just part here. No, nobody's concerned about that. Likewise, we've seen Kuwait start to sell a little bit less to some of the Indian refiners that are taking a lot of the Russian crude. So again, that's kind of a happy passing of convenience at the time. On the other side of the equation, obviously Kuwait now has a lot more refined products to sell. KPC was kind of saying that they were a bit worried that they're going to be bringing on Al Zour and not really have anywhere for the fuel to go, especially given how much of it is of heavy fuel, low sulfur heavy fuel oil. But we're seeing Europe have a massive demand for new sources of all of these products. So Kuwait is shipping a lot of these products into Europe. So it's really been quite a convenient time for them to bring these facilities online, and we'll see how they handle that balance going into 2024.
James, I know it's a kind of a roundabout way to get a sense of the geopolitical risk in the market, but I do think it has relevance. The sort of optics from Europe and the West vis-a-vis the tragic events in Gaza in recent days. I think yesterday reported nearly 1,000 people killed in one day. A scale of which we haven't seen before. Public opinion swinging in Europe against this action, consequently maybe curtailing Israel's intention to go in on the ground, and so consequently reducing the geopolitical risk? I mean, the oil price is reportedly falling because the geopolitical risk is being taken out of it. And I'm wondering, from your perspective, sitting deep in Europe, whether there is a shift in sentiment towards the sort of acceptance of this scale of massacre.
I definitely don't think there's a shift in terms of the acceptance of the events in Gaza. And I don't think there's a shift in public opinion. I think public opinion, Sean, has been very robust from the very, very beginning. But what we're actually now seeing is it's flowing onto the streets, it's flowing into protests across every major capital in Europe, and indeed in elements of the United States. I mean, clearly, where the conflict has moved in the course of the last week is that the politicians who have been, I would suggest, wildly out of step with what public opinion was as soon as the events occurred, and indeed have firmed up as events have progressed. We find ourselves now where the public are calling into question the positions which their governments are taking. It's certainly in the UK and the United States, which their senior politicians are taking. The words that are being used by the media sources also being called into question. And what I think we're seeing on the ground is quite clearly a reduction in the confidence that the UK, the US, and indeed Israel has around the actions which it has been taken. And that is what has led to deferral of any movement on the ground. It's led to a wind back in terms of when that would occur. And it's led to a wholesale global response level as to the total unacceptance of any country breaching humanitarian laws. Ironically, I don't know whether any of your listeners will have picked up, but ironically, yesterday was the birthday of the United Nations, created on October the 24th, 1945. It would not have been a celebration, for sure, by the United Nations. That organization was created, as we know, to manage and to mitigate international conflicts and make sure that we never found ourselves in the kind of circumstances that we found ourselves at the end of World War II. And clearly, the views and the perspectives of Antonio Guterres a week ago were just being ignored. Now they're front and central in terms of any political organization, in terms of what it says or indeed what it does. And I have to say, I have been deeply, deeply moved to see the level of public objection across all of the major capitals of Europe, and to be honest, it gives me hope that in actual fact that our politicians will begin to realise that you are in a democratic world elected to follow the views and the perspectives of your public, and indeed I think that's what's causing the wind back.
Paul, I wanted to get your thoughts on where China's at. We saw yesterday announcements by China of sort of stimulus in the form of more loose lending and liquidity available to the market, and the oil market itself seemed to respond positively to that, and has since dropped away. Where do you think China's at the moment as a pillar of in this demand outlook?
Yeah, I think it's still sort of in the middle of the two extremes the market's been sort of concerned about, or that, should say, analysts have been pushing as being the a base case. It's not as disastrous as the worst case is. It's certainly not been as strong as the strongest cases put forward. It's a gradual recovery. We're very optimistic about the GDP over the next year or so. It's outperformed relative to most expectations over the course of Q3. So it's a solid economic performance and seems to be gaining strength. But again, with that proviso that think in that terms of being down the middle solid rather than being going gangbusters strong or necessarily just being propped up and weakening away. So I think, again, very much in the middle, but still outperforming most expectations, which is why the market should take most of the global economic news positively. It's better than a very sort of, if you like, negative consensus that's arisen over the past few months.
I wanted us to get the survey question before getting Jamie to comment on the survey question ultimately, which is that the global spare oil capacity of 5 million barrels per day has trumped the geopolitical premium risk that has emerged, whether it be obviously the Ukraine war and now the Palestine conflict that has pushed prices back into the 80s. I mean, there's just purely too much oil supply available to be too worried about what is ultimately not a great risk to supply of oil. Agree or disagree with this statement? Jamie, your thoughts on that vis-a-vis the idle capacity, whether it trumps or not, is a secondary subject. But we are seeing now increasingly, with obviously the Saudi unilateral cuts in particular, a significant amount of spare capacity in the world today, and more coming perhaps with Guyana, with Venezuela. And your thoughts there about how does OPEC Plus navigate this growing spare capacity?
Yeah, Sean, you're absolutely right. There is clearly a lot of spare capacity at the moment, and it's always interesting looking back at the situation exactly a year ago when, at FII conference in Riyadh 2022, Prince Abdulaziz, the Saudi minister, was saying that the absence of spare capacity was a major driver of the volatility that we were seeing at the same time last year within the market, saying that you could find yourself in the situation where OPEC Plus kept increasing production as they were being called upon to do, and that would be driving prices up because the market would be focusing on the fact that we were eroding this tiny cushion of spare capacity that we had. Fast forward, 12 months, and suddenly the debate is very much the inverse of that. That we've got this massive cushion, and that is providing huge relief to the market. Is it overwhelming the geopolitical premium at the moment? I think that, as Paul was saying earlier, the market at the moment is not too concerned by some of the geopolitical risks at the moment. Everybody, I think, Ukraine is kind of, from an oil market perspective particularly, it's not on the top of everybody's minds at the moment. It's adding a lot of friction to global trade, but on a supply-demand basis, I think everybody's pretty happy with where we are at the moment. With, quite frankly, they've been surprised at the pace at which new trade patterns have been redrawn, and at how resilient the global supply chains have proven to be. I think with the current situation with Israel and Palestine, everybody's a little bit confused in a way. They see Israel-Palestine Middle Eastern threats as, oh, this is something that my father would have been massively concerned about, that this is what caused price fights in the past. But then they look at the facts on the ground and they're just not quite sure exactly where there could be near-term supply outages from. I think the most obvious thing would be perhaps a tightening of sanctions back on Iran. And some people have certainly speculated that the easing of sanctions on Venezuela is a prelude to that the US is trying to bring online another source of production to offset that. Venezuela, as it happens, I think would be a very incremental amount that would be brought back onto the market. It's the situation in Venezuela has been quite severe for quite a long time. I think it'll take them a long time to bring back that latent capacity that they have. So then in terms of where other sources come from, you're absolutely right about Guyana. The UAE is obviously somewhere that's also bringing a lot of capacity online, and indeed some of that capacity will be realized when their OPEC plus quota does get increased in January by 200,000 barrels a day, I think it is. So that's something that on that side, both capacity is increasing and also real barrels onto the market.
James, I saw you there shaking your head a bit on that idle capacity question. I just add to it for your thoughts, but the idea that Latin America becomes the new big growth market now. I mean, the Americas as a whole, perhaps, right through north to south. Your thoughts?
Look, I think that's not going to be a short-term fix, which I'm picking up on Jamie's point. I mean, give you a perspective. I know Venezuela has been in the news a little bit in the last week, and indeed, The United States has given licenses to the big service companies, Schlumberger, Baker Hughes, Halliburton, to go back into Venezuela and as part of the supply chain there. But give that some perspective. In 2014, there would have been north of 80 rigs operating in Venezuela. Today, there's one. So that gives you an idea just how quickly or not Venezuela will be able to turn around their production. But clearly, there is a change in sentiment there. The press digest today, I think, touches on pretty much all of the key themes without there being any big moves. As I said earlier on, a lot of rhetoric, but no big moves. Clearly Prince Abdulaziz pointing out the world is returning to north of 100 million barrels of oil a day consumption. The US stock markets continuing to, outperform expectation. It's earnings season there. All of the 500 S&P 500 companies, 118 have posted so far. 80+% of those are above expectations. The relationships of supply demand, China looking increasingly, as it has been for some time, towards the Middle East to supply, and off the back of that, doubling its refining capacity. So back to Jamie's point around refined product being the story of the day at the moment, that's happening right across China. The energy transition not happening fast enough. Total's CEO pointing out that renewable energy consumption as part of the mix is only around 15% right now, and that's not enough. The companies that focus on energy transition, their share prices, being adjusted as they take a stronger position back towards traditional fossil fuels, and as a consequence of that, ultimately responding to wider political need. And the NOCs and the IOCs will be the dominant players in that space going forward. So all of those stories are in your mix, Sean. It's a really healthy, balanced perspective of where we are today, but nothing big in terms of moves, but lots in terms of comment. And I think pretty much you've captured the essence of where we'll be going over the course of the next few months, assuming there is no other black swan event, as you are prone to focus in on.
Yes. Well, I think that's one thing for sure, that they seem to be quite regular. Paul, just closing out, looking to the immediate future, we're going to soon be swinging into trading January contracts on the markets with the expiry of the current month. Your thoughts as go into what is traditionally a more weaker window of the first quarter of the year in terms of the trading and delivery. Is this a downward motion market now? Because even with the geopolitical risk, as we say, being squeezed out of the market, that this is a weaker window that we're moving into. Your thoughts?
No, I don't think so. You're right. January is always seasonally the weakest month. It's the weakest month for demand through the year. What was different this year was there was an outsized surplus in January. It wasn't just that there was the normal seasonal one. It was a whopping great surplus. We haven't got anything like that in our balances for this January. On ours, there's still a stock draw across Q1, about 600,000 barrels a day. So we've got draws every single month, having started in July, right the way through to March, with the exception of January. So I don't think that weakness is there. I think as people start to concentrate on the 2020 full balances, oil will start looking very, very cheap. Again, with spare capacity, you don't worry about spare capacity when more than 2/3 of it is held by one country. You start getting very interested in what that country thinks would be a good price for oil. But if anything, it's a guarantor that of continued cohesion within OPEC plus. So I think it's a positive rather than negative in the context it was come up with. For next year, we see demand at 1.5 million barrels a day of growth. Non-OPEC supply, a lot of talk about Guyana and Canada, etc. Add it all up, take away the decrements, you get 900,000 barrels a day of growth from non-OPEC, which is slower than this year, slower than last year. So I think some of this sort of, the danger is focusing on tiny little bits. Guyana, Venezuela, let's look at Brazil.
Well, they're not exactly tiny. I mean, Guyana's up to over 1 million barrels in its destination, and Venezuela, of course, was 3 and a bit when it was in its not in so long ago in the wheel of time. And if indeed these sanctions remain lifted, you could imagine that there would be recovery there next year.
Yeah, but Guyana was 100,000 barrels a day this year. We think 168,000 barrels a day growth next year. I mean, you're right, it's incremental, it adds up, but looking on a 1 year, 2 year basis, that really doesn't move
the needle.
Yeah, and in general, most of it, we do see the market as being, once it starts to refocus on fundamentals, will strengthen again.
And given, Jamie, which is, I think, that we're kind of out of, as we move into 24, we're moving out of that recovery from COVID window, if you like, where 2+ million barrel a day of demand growth. And now we're on the top end. Paul mentioned 1.5. I think that's on the range, the top end of the forecast range. And some are even indicating as low as 1. Your thoughts on what that means when we have these, yes, not massive incremental increases, perhaps in the Guyanas and so on, but you add them all up, it doesn't leave much room for any growth in the Gulf.
No, you're right. In terms of a lot of the forecasts that OPEC comes up with, their big increase in production share globally tends to be just around the corner when you look at their reports. They're always 5, 6, 7 years time rather than immediately. I certainly get the, if you look at what OPEC Plus's production plan at the moment is, the cuts as they are stay in force until the end of 2024. Frankly, we see no real momentum within the group at the moment to change that. So when you look at what's going to happen, I was just kind
of wondering, I sort of myself thinking that with this extra capacity building outside of OPEC Plus, that there might be a desire to say, hey, why are we giving up market share here? We should be producing more.
It's always the balance that they're trying to make there. There's always the risk as well that with price, the high sustained prices, clearly they say they want that investment going into the market, but the risk is that reduces their market share even further. It's an ongoing debate within the group, Sean.
James, last word to you on where we started, the mergers in the US majors, what that means on the medium term for production. In some ways, we went through a very maverick, pioneering ramp up of US oil production in the shale basin with the mom and pop drillers. Now the big boys have their grip on everything. You would imagine that sort of slows everything down and probably bullish for medium-term prices. Your thoughts on what it means of the medium term for production in the US?
I think steady as it goes, I think, is the answer. The big companies obviously have the deep pockets. They also are taking increasingly control. Jamie's point around and Paul's point around the amount of the market share which OPEC has. Clearly the IOCs have always been in a backseat driver with regards to that. They are strengthening their position. They're strengthening what role they will perform in the supply curve going forward. But it's not something which is going to change, as Paul I think said, in the sort of short term, and it'll be slow in the medium term. They're consolidating their stock prices, they're consolidating their balance sheet, and they're getting ready to invest. But it's not going to come through in the course of the next year or possibly even 2 years in any major way. And so I think the hold which OPEC has, if indeed it is a hold on prices, although stability is always what Prince Abdulaziz says that OPEC is about. I think we have relative stability in terms of the supply demand curve right now. Always, as I've said earlier on, having to be responsive, if you like, to what's actually happening in the markets and indeed global events. But no big changes, and that's what I think the press digest shows.
Yeah. Let's wrap it up there. Brent crude oil trading down 0.5% at 87.65. Thank you so much, Paul Horsnell in the UK, with Jamie Ingram also in London, and James McCallum in that amazing little country called Ireland. Thank you so much for your thoughts and insights this morning. We really appreciate it. Have a great day. Bye-bye.
Thank you all. Have a good morning. Bye-bye.
Cheers.
Thanks, Sean.